Hey, welcome to The Explainer. In the world of investing, it's so easy to get caught up chasing the next hot stock or the next big thing. But the investors who really succeed, the ones who are still winning decades from now, they don't just play one game. They actually play two. They've mastered both a powerful offense and an absolutely unbreakable defense. So today we're going to break down this dual playbook, a framework that can seriously help you build a resilient, high-performing portfolio for the long haul. Okay, let's get right into it. First, we're going to get grounded in the long-term mindset that really separates the pros from the speculators. Then, we'll dive into the two critical roles every investor has to play, the thrill of the chase on offense and the disciplined art of survival on defense. We'll even unpack the surprising role dividends play in all this. And finally, we'll pull it all together so you can see how to build your own championship team. All right, before we even whisper the word strategy, we have to talk about time. Seriously. Because if you don't have the right perspective, the best strategy in the world is going to fail. To really win over 10, 15, even 20 years, you first have to understand the single biggest trap that derails almost everybody: short-term thinking. This analogy, it's a bit dark, I'll admit, but it is a perfect illustration of a massive investment risk. Just imagine it. You're the turkey. Every single day for 100 days, you get fed, you're protected, life is good. You start to think, wow, this is how the world works. These farmers are my best friends. You mistake a nice, positive trend for an unbreakable law of nature. But we all know what happens to that turkey on Thanksgiving. Relying only on what's happened recently, it's a trap called recency bias, and it can make you completely blind to a catastrophic risk that's right around the corner. And that's the key takeaway right there. When we shift our focus out to a 10 or 20-year timeline, the whole game just changes. I mean, the day-to-day market, it's chaos. It's all emotion and noise. But over a decade, a business's success comes down to fundamentals. Its earnings, its strategy, its real advantages over the competition. A long-term perspective is like a filter. It lets us just tune out all that daily static and focus on the one clear signal that actually matters: the company's real trajectory, the path that actually builds wealth over time. Okay, so let's get into our offensive strategy. This is the fun part, right? This is all about finding those rare, special companies that have the potential to deliver truly explosive, portfolio-changing returns. We're not talking about small wins here. We're talking about hitting absolute home runs. Now, check this out. This slide really shows the raw, incredible power of compounding growth. So you've got Company A. Looks pretty solid, right? Grows along with the market, pays a nice 5% dividend, no complaints. But then, look at Company B. Yeah, the dividend is smaller, but look at that growth rate, 26% a year. That's not just adding to your returns, it creates a compounding tsunami. After a decade, it's worth 5 times more than the safe company. That's the magic of offense. True growth doesn't just add, it multiplies. So the big question is, how do you even begin to find a Company B? Well, you have to be willing to think really, really big. And this simple question forces you to do just that. It makes you look past next quarter's results and start thinking about the company's total addressable market. Like, how big is the entire pie they could possibly eat? It forces you to look at their competitive moat. What's that special thing that keeps rivals away? This one question pushes you to figure out if a company has a real shot at dominating its industry for years and years. And here are the traits you're looking for, the telltale signs of an offensive powerhouse. You don't just want growth, you want accelerating growth. You want to see those annual earnings climbing by over 25% year after year. And this is critical. There's almost always something new driving it all. Maybe it's a game-changing product, a visionary new CEO, or the entire industry is shifting. Just think about companies like NVIDIA or Microsoft. They have repeatedly used something new to ignite these incredible periods of growth. But playing offense also means you need a healthy dose of skepticism. This slide is kind of that wow moment, but it's also a huge reality check. The law of large numbers is a really powerful force. So while we're out there hunting for that explosive growth, we have to constantly be asking ourselves, are my assumptions even realistic? Can a company this big really keep growing at this insane pace? See, a great offense isn't just about dreaming big, it's about grounding those dreams in reality. Okay, so a pure offense strategy might get you some spectacular highlights, sure, but it also leads to some pretty spectacular flameouts. The investors who are still around in a few decades, they know that winning isn't enough. You also have to know how not to lose. So it's time to talk about the other half of the game: survival, durability, and managing your risk. This quote from Howard Marks is really the core philosophy of defensive investing. It's a huge shift in mindset. Instead of always asking, how much money can I make? The defensive investor asks, how much money could I possibly lose? And that's because avoiding a 50% loss is way, way easier than finding a 100% gain just to get back to even. Focusing on not getting wiped out is just a more dependable, reliable path to wealth than chasing home runs all day. So let's lay out the non-negotiable rules for your defensive playbook. Rule 1, you insist on a margin of safety. That just means buying something for a lot less than you think it's actually worth. It's your cushion. Rule 2, you avoid too much leverage, too much debt. Like Buffett says, anything times 0 is still 0. Rule 3, you diversify. Simple, right? Don't let one turkey situation blow up your whole portfolio. And finally, you stay within your circle of competence. Only invest in what you truly understand, and you're always on the lookout to weed out the weakest companies you own. A huge part of playing defense is just being aware of what's happening in the broader market. This table is a great guide. It shows where the big money tends to go depending on how investors are feeling. When everyone's feeling confident and bullish, money just floods into these risk-on sectors like tech. But when fear starts to creep in, you'll see a big shift, a rotation into risk-off sectors like consumer staples and utilities, companies that sell things people have to buy no matter what. Watching for that shift can be a huge warning sign that the whole game is changing. Okay, so where do dividends fit into this whole offense-defense picture? A lot of people see them as a purely defensive move, a slow, steady, maybe even boring source of income. But that view really misses the bigger picture. Dividends are actually a super crucial, highly strategic part of the entire investing equation. Let's just reframe this whole question. We need to stop thinking about dividends as just income. We need to start seeing them for what they really are: a direct return of actual profit, a sign of a disciplined management team, and a really powerful engine for compounding your total wealth over time. So the bottom line is this: what you actually walk away with is your total return. A dividend isn't something separate from your growth. It's a huge part of it. That cash payout gives you capital that you can then turn around and use to buy more shares. And that creates this awesome self-fueling cycle. More dividends buy you more shares, which then generate even more dividends. It's a wealth-building snowball that can seriously speed up your results in the long run. Now, what's so interesting about this slide is the story it tells about the quality of a business. Look, both companies are achieving the exact same growth, but Company A is way, way better. Why? Because it's so efficient with its capital that it can grow the business and hand cash back to you at the same time. Company B, on the other hand, has to pour every single penny it makes back into the business just to keep up. A dividend isn't always a sign that a company's slowing down. A lot of the time, it's the mark of a truly dominant, cash-gushing machine. So what's the final answer? Should you be an aggressive growth investor or a cautious defensive one? Well, the truth is, the greatest investors, they don't choose. They don't see it as offense versus defense. They masterfully combine them both into one single winning strategy. And that right there perfectly illustrates why you need balance. You can't win a tennis match just by hitting a few powerful smashes. You also have to consistently get the ball back over the net, you have to stay in the point, and you have to avoid stupid mistakes. In investing, your big growth winners, those are your smashes. But you win the long game by playing solid defense, avoiding those big, stupid losses, and just staying in the game long enough for your offense to actually work. And this is where it all comes together. This is the ultimate synthesis. Your offense is what identifies that high-quality, innovative, growing company. It's the kind of business you get excited about, the one you'd be thrilled to own. But then your defense steps in and says, whoa, hold on, not yet. Your defense demands discipline. It refuses to overpay for anything, and it will wait patiently, so patiently, for a price that gives you that margin of safety. A great company is your offensive play. Buying it at a great price, that's your defensive one. Together, that's what creates a truly outstanding investment. And that really brings us to the final and maybe most important question you should ask of every single investment you ever think about making. It forces you to play both sides of the ball. It acknowledges the company's quality, that's the offense, while respecting the absolutely critical role that price plays in your final return. That's the defense. By always asking not just, is it great, but also, is it safe? You're equipping yourself with that dual playbook you need to navigate any market and win the long game.